A quick introduction. Ellie Wheeler is a principal at Graycroft and has been there for about 4.5 years, very actively involved in the New York venture market. I told her she and I hadn't actually met in person until today, but I hear about her everywhere. And so she's developed a very good reputation with investors, or with companies. So I will tell you, first of all, that the term sheet that she's presenting to the company is not an Ellie Wheeler Graycroft term sheet. This is a Christopher Austin Oric term sheet, which has all these terms. And she said, really? I'm asking for that? So she's going to try really hard to actually negotiate some of these terms, because the fact of the matter is that this term sheet that we're using isn't that far off from some that I've seen. And one of the things we'll talk about is, as part of this, is how you think about this in a holistic way. Liz is in the fortunate position of having started her company a bit over a year ago and already raised her Series A with General Catalyst, which is a very good fund. And as she said, it's nice to have a West Coast investor. I told her I spent 15 years in Boston. They're a Boston investor, right? It was a Boston fund for years, but they've really made the transition to where a significant part of their activity, and even an activity in New York, is out of the West Coast.
It's nice to have an East Coast investor that thinks like they're
East Coast investor who thinks like they're a West Coast investor, even better. We'll talk a little bit about that along the way. If you have questions, please let us know. I do think that there are some East Coast, West Coast differences at the margins on things. It's not like it used to be. 15 years ago, the term sheets that you would get would be fundamentally different between an East Coast and a West Coast fund. And there's a lot of standardization. So one of the things that we want to talk about today is focusing on the important stuff, because there's been a lot of standardization over the years. The NVCA, the National Venture Capital Association, has a set of Series A documents that people can use. I've used them for many, many deals. They're actually pretty middle of the road. They have good explanations. So frankly, a really good place to go after this session, if you want more information, go read through them, because the term sheet is one thing, and the documents are actually reasonably plain English, says the lawyer, but they're reasonably plain English, better than they used to be. And you can kind of see what they say in terms of what some of the different alternatives are and how they work. So what we're going to do today is we're going to have a quick run through of the anatomy of a term sheet, and see if I can make this. There we go. And we'll talk a little bit about structure. You have all the materials in the packets, and there's a PowerPoint, which is what we'll be looking on here, and then there's the actual original form of the term sheet. I didn't give you our cheat sheet notes. And there's also a one-page cap table, which is a pro forma cap table. If you let Lauren know, we can email around the full Excel version, and it's one that's available online. I said I'm not going to take a client's term cap table. S3 Ventures has one online, and I said, okay, I can whip through that and put it together, and it's actually a pretty nice, it's a pretty good format. Okay, so let's talk just briefly about how a term sheet is set up. And there is a screen up there which is hard to see, so you can guys see where we are in terms of the PowerPoint. Sort of three big categories of things that you see in a term sheet, and we'll focus on them kind of in groups. And one is allocating value. So there's a whole bunch of different terms. That it's not just the valuation. It's a $10 million pre, right? That's one piece of things. The other is how the capital structure works. So including how many options are reserved in the option plan, and there's liquidation preferences, and there's dividends. So we'll go through those in a little bit more detail as we go along. Then there's kind of governance type issues. Don't ignore those. One of the things that we talked about when we were getting ready for this is that the VC company relationship is a long-term relationship. Maybe you get lucky and sell your company a year after you get your Series A, but probably not. And probably that's not the best outcome for the VCs. And every once in a while it could be good, every once in a while, but not generally. And so usually it's a multiple year relationship, and it's a relationship that you keep adding additional parties to. And so one of the things about the Series A that's really important to think about is that you're setting the basis for the documents for many, many rounds of financing going forward. And that's why when we talk through this, you're going to see some bias as we talk. As I've advised Liz, my client, as we think about this, that sometimes you don't necessarily go for the last dollar evaluation. She actually brought it up first because and she'll talk about some of her experiences in that. The non-valuation points include both who the VCs are and also the governance issues. So how is the board governance structured? How are decisions made? What things do the VCs have the opportunity to have a say in? And then there's investor rights, which is more broadly things like what are the information rights that are available to people? What are my rights to sell my stock? What are my rights to stop the founders from selling their stock? And if we have time, I'd like to talk a little bit about this. This is actually one that for years and years, I haven't really focused a lot on the transfer restrictions, especially as to the VCs. VCs in general say, founders, you're locked up with the right of first refusal on your shares. The VCs are able to transfer their shares freely. And what we're finding with a lot of our later stage companies is that's changing. I had a phase where I sort of managed to get this imposed everywhere, where everybody signed up to the ROFR and the co-sale agreement, and then it went to the VCs kind of going back to saying no, we don't want to do that. And we'll talk a little bit about how, again, trying to align everybody's interests in the same place. And it's one of those things that the governance issues sometimes are almost like a religious item for the VCs, that there might be some points that you're just not going to win on. And so part of the discussion is figure out how a particular fund or venture partner is going to think about those things and how they'll interact with you as you go along. All right, so the valuation here. It is a science and an art. We were talking about, what is the range of valuations? People always ask, what should a Series C be? What should a Series A be? The fact of the matter is, used to be that a Series A might be a, 3 million round on 5. That was a pretty, reasonable Series A. That's barely a seed round sometimes now, and people are doing multiple. I've got companies that are doing seed, Series Seed A, Seed 3. And they've raised $15 million and they're still doing, quote, seed investments. And so I don't really know. I mean, Ellie, from your perspective, if you had to say sort of what distinguishes a Series A from a Series Seed, what are the sort of key things that you would think about?
So it used to be based on the milestones of the business, and I still think it should be. But I think your point is a fair one, which seed rounds getting bigger, seed rounds, seed extensions, seed plus, seed prime, I don't care what you call it. There's a lot of those. The reality is upstream VCs also recognize, hey, you've raised $10 million. You've called it a seed all along the way, but we're expecting to see kind of progress in the business that's requisite with having raised $10 million, whether you're calling this your Series A or not. So, the seed, I think, is what's changed the most, and then, kind of the Series A has followed.
Right.
But it still should be milestones of the business.
And in terms of valuation amounts, Series A is sort of 8 to 15
Yeah,
million?
it used to be able to do single digits, and that's increasingly rare. So yeah, 8 to 20.
Yeah.
But we're increasingly fixing the post.
Okay. And so we'll talk about what that means, which is fixing the post in terms of fixing what the post-money valuation is after they put their money in. As company counsel, I always like to make sure we fix the pre, because that way, frankly, as we go along, if Liz is really good at raising money and she goes out and says, I'm going to raise $4 million at a $10 million pre, and Ellie says, fine, we'll do a $14 million post, and then she raises 5. What does that mean, right? So it's either 5 on 10, so a total of 15 million post, or it's 5 on 9 all of a sudden. And so,
Right. But that changes my ownership.
Right, changes your ownership, and there's good reasons to do that. Another thing that we're not going to really get into today, in our because of the seed, sometimes people do priced seed rounds. There's a bunch of documents like the Series Seed docs, which my friend Ted Wang at Fenwick put together. I was really skeptical at first, but people are actually using them. But a lot of people use notes. And so there's a debate sometimes about the notes. Should the notes be part of the pre-money? And the argument in that case, these are all things that are in the mix that people are going to talk about. So the notes be part of the pre-money. And if you've spent all of your money and the notes came in a year and a half ago or 2 years ago, and you raised $2 million in notes, it looks a lot like a seed round. right? That if you had done a seed round, then in terms of calculating the valuation, it would be you would include the shares that were issued in a seed round. But you might also have a situation where you raise a note round and very quickly go out and raise the Series A, in which case they wouldn't be considered part of the pre-money. So there's some really interesting. There's a lot of stuff that goes on. So we'll capture some of that today. We won't capture all of it as we go through. In terms of the amount of the investment, no matter what the valuation. Usually investors who come in want to own somewhere between, it says 20 to 40, I would say probably 20 to 30%. Sometimes they'll do less. Certainly as we get these mega rounds now for these mega companies, you get, all bets are off and you get sort of DE round. There's whole different metrics that go into that. But at the Series Seed and the Series A round, you should assume that an investor wants to come in and own something like 25%. So that's one of the places where how much money you raise. So what can I productively do in the next year to 18 months or 36 months in some cases if you've got a really good plan with the amount of money that I'm raising. And as part of your calculation in terms of thinking about how much dilution do I have to take, how much money do I really need until I hit a new valuation milestone. So as Ellie said, that the Series A should be thought of as a milestone-based concept. So go ahead. Well, so we'll talk about the coupon. What coupon? It's not a coupon clipping business. Exactly. So we will come back to that because, yes, in terms of thinking about things, you have to model out. And the coupon would be does that include the coupon? The coupon would be an accruing dividend. And we'll talk about that as we go through.
By the way, I just figured I'd mention, when we were raising our Series A, we were when I say we, my co-founder and I were very strict with ourselves on not wanting to give more than X% of our company up for that round. We also didn't necessarily need to raise, which is happening a lot these days. So that was a really good way of keeping us kind of like strong to our word about not raising too much, because we knew our valuation wouldn't get too high unless we took from investors who didn't really know what they were doing anyway, or whatever it might be. So that was like a really good technique that I've given to a bunch of my friends are starting to say, okay, I'm going into this round and I'm not giving more than X%. And it's actually really helping them kind of stay grounded, if you will, in this crazy environment.
Right. And it is something that it's a little bit of a feast or famine for folks, that there's a lot of people who have a real hard time raising the A, and then there's people who've got multiple term sheets. And it's hard for me as an outsider sometimes to predict which one's going to be which. And there's a whole bunch of factors that go into it. But I do think that concept of fixing a point in the ground for yourself and saying, okay, I'm going to be disciplined, because VCs can be very persuasive. Oh, you're raising 4, but if you raised 10, think what you could do, And so, right, and they do, and they might be right, But you might say, I'll raise 4 now. We'll see how it goes, and a year later we can come back. I'll be able to raise the next 6 at a much higher valuation. Okay, so we're going to talk some about founder vesting, and I'm going to speed up a little bit through the rest of this stuff. Founder vesting. I'll let them kind of have this discussion. It's actually a very interesting discussion. Generally, a VC in a Series A round is going to come in and basically, if you're not already having your stock vest, so in other words, if it's not at risk if you leave, then we need to impose vesting. I recommend to founders always that when you start a company, that you put vesting provisions in place. You do it for a couple of reasons. One is so that you've already got some track record. When the VCs come in, you can say, we've thought about this, here's how we've done it, how we've structured it. If it's reasonable, they might let it say like you have it. And at least it gives you a place to negotiate from. And the other place that's very important to think about is that founder vesting is actually your friend. Because I always tell people, think about what you would want to happen if you were the one who left. So if you decide to go off and do something else, or if you're the one who stays behind. And the founder vesting, as among founders, everybody else says, oh, we love each other, it's all great, until somebody doesn't pull their weight and they leave, or somebody has a better idea and goes off to do something else and walks away owning a third of the company. The people who are left say, right? They didn't do anything, and I'm left here and I've got a third of the company outstanding, which causes real problems in all sorts of ways. And so to having this discussion, very standard is a 4-year term with a 1-year cliff. I'm sure you've seen that in different places. That is almost ubiquitous. There are a few people who want to push it out. I've got some founders who want to make it 5 years because they want to tie their employees more, but I think it's nearly universal. So another issue which we'll talk about is the stock option pool. How much stock do you have to have left? And that goes in, and this is also part of the valuation discussion. So when we talked before, valuation is the pre-money equity value of the company. It's the unallocated stock option pool, and we'll explain a little bit more about why that's important, because they count as outstanding shares for purposes of calculating the ownership of the VC coming in. There's the dividend, whether that accrues over time and so gives more value. And then there's whether the stock is participating preferred or regular preferred. So in terms of the equity summary, you've got the thing, we want to align interests here. So dividends. See, look, this is not a coupon investment. This is something, a number of these terms go back and forth over time. In 2007, 2008, as the financial crisis was hitting, people started adding more accruing dividends. It's very, very rare at this time. It is not unheard of. And you may have a VC who finds them very important. The difference is that you can either have dividends that are paid if, as, and when declared by the board, never, or they can accrue every year. And so think about it. It's like any kind of interest. If you have a $100 investment, you've got an 8% coupon, and it accrues, so it's not getting paid. At year one, it's 108. Then it's 116.50 or whatever the math is. And over time, as companies are private longer and longer, that can add up to real money. I had a company that was sold after 8 years, and the dividends on the Series A and the Series A1 basically matched the principal, the face value. You sort of think of the rule of 7 in terms of doubling at certain levels. Let me see. And so what we'll talk about, we'll go back and forth on what the arguments are there. This is one that Ellie's going to have to force herself to argue. The other is liquidation preference. Liquidation preference is really important as well. This is really the key distinguishing feature. When you talk about preferred stock, why is it preferred? Preferred stock has a bundle of contractual rights. The dividends are one. Liquidation preference is another. It's the right to get the money first. When you sell a company, they talk about the liquidation waterfall. Basically, the senior preferred gets their money first. Actually, debt gets their money first. Then the senior preferred, then junior preferred, then the common. And in VC land, there's a form of preferred stock called participating preferred. And that's called have your cake and eat it too. Because I get my money back as the preferred, and then I share pro rata with the common based on my percentage ownership as a company. So if you count my preferred stock as converting to common. And so we'll talk a little bit about this. Again, in a case where you've raised $20 million and you sell for $1 billion, nobody cares. In a case where you have raised $20 million and sell for 40, which isn't going to be anybody's idea of a great outcome, but is something that happens a lot. You have to plan for it. It can cause a real issue. Let me see. Protective provisions. This is one, again, where the VCs, this is a governance issue, not directly a value issue. And the protective provisions are the places where the VCs have an opportunity to have a veto. So in the term sheet that we sent, we'll spend some time talking about this. There's sort of fundamental company issues. There's issuing more stock. If you think about the ones that make total sense, and if you think about what they're doing, the VCs are basically saying, we don't want our value to leak out of the company. So we don't want you to put additional shares of preferred stock in ahead of us who get money first. Again, it's really important in some circumstances. We don't want you to borrow a bunch of money without our consent. We don't want you to pay dividends to the founders. We don't want you to buy back founder stock, because buying back founder stock is a way for value to go out, and you're using our money to buy their stock. And then there's the other kinds of things that end up included a lot of times, and this is what we'll spend some time talking about, are more operating types of things. They might have control over the budget. They might have control over hiring or firing the CEO. And we'll talk a little bit about where those things are appropriate. But there are some VCs that are absolutely insistent that those be stockholder vote issues that are included in the charter. Board composition, pretty classic for a board is to have 2 or 3 people at the Series seed stage, usually a couple of founders and a seed investor. And when you bring a preferred investor in, it causes an interesting dynamic. And Liz, let's talk about this for a minute, because we talked a little bit about the question. A lot of people, entrepreneurs feel that the board is an enemy. People who are going out to raise money kind of feel like, oh, I don't want a board. I'm going to hold off on having a board as long as possible, because that way they're going to try to tell me what to do, puts me at risk. And we had an interesting conversation about this. I mean, it's not at all my view, and we'll talk about why, but hear about what your experience was.
So a lot of my friends had this misconception going in, and I might have at the very beginning as well, that like VCs are evil and they just want to kick you out of your company or something like that. First of all, not the case. At least none of the ones I've ever heard of or met. But what we were talking about on the phone earlier was the fact that, you know, we were very fortunate enough to have received, I think, 6 term sheets, and the one we took was definitely not the highest valuation, but it was with the fund that we knew we kept saying, go to war with us, not against us, but go to war with us, and the one that ultimately, other parts of the term sheet were extremely favorable. And then also one thing that we were talking about here was like, they wanted a board seat, and actually one of the funds that were offering us a higher valuation said, we don't want a board seat. And I'm a first-time founder. I worked at Google before this. I've never, heard of any of these terms more than a year ago. And so for me, it was really important that someone was in the room making sure that I wasn't effing up. And so, sorry, I don't know if there's any babies here.
It's a technical term.
Yeah. So, I mean, I can say at least, on one hand, we are working with an awesome fund. I recommend GC to everyone, and Greycroft. But on the other hand, and so I will say for that, we've been very lucky to the extent that every single board meeting we have, we leave with like 1 million amazing to-dos. They haven't tried kicking me out yet, and I don't think that they're planning on it. But overall, it's really kept me in check. And every single board meeting, as much as we hate preparing for them, we leave and we're like, wow, we just learned 15 different things about our business that we really should have known. And so I have yet to regret it, but also it's like the biggest misconception that having a board member is a bad thing. I think they really keep you in check, especially if you're a first-time founder.
What do you
Ellie,
think?
anything to add on that?
I mean, I'm biased, but you can have, first rule, do no harm, right? Like I've experienced destructive boards, people who, it's distracting, it's a complete waste of time, it's totally just unproductive. People who like to hear themselves talk go on for hours on tangents that are just completely irrelevant, and generally make it a difficult thing and make it difficult to just operate a business. So, you need to due diligence on that and make sure you know who you're signing up with. But I would say that generally. But on the whole, having accountability and having governance and having that kind of transparency is essential, and it's important to do it early, such that it isn't a complete shock to the system when suddenly that matters, because eventually all these businesses need to grow up and get their financials done on time and have things audited and understand what the metrics are and be able to communicate that in a way that's effective.
I'll say Fred Wilson was quoted somewhere saying that the number of board members you have is adversely correlated to the success that a company will have. So it is one of those things that you don't want to add like 4 board members. Be careful with that.
Early on.
Yeah, at least early on, yeah.
So to that point, what is the ideal?
There's no ideal number. I think somewhere between 3 and 5.
For us, we have my co-founder, myself, 1 board member from General Catalyst. We have 1 observer, which means they don't have voting rights. And we're right now in the process of finding that independent board member, which is a whole process in itself.
And as a lawyer, I'm a little nervous about a 4-person board. You can get away with it, but it causes there's a risk of a deadlock in a 4-person board. So I have a bias towards 3 or 5. But the fact of the matter is that 99% of all decisions are by consensus.
It doesn't come down to a vote. It just doesn't. Not at this stage of a company. So it's really not relevant.
The situations that you've been in that were just a board member talking.
It's hard to get rid of board members.
Exactly. So is it more, were they larger boards or smaller boards?
Smaller.
It doesn't really matter. Yeah, that you can have non-productive people at any one, but that's why it's very important. It is, the fear of getting kicked out by founders is one of the things that actually we'll talk as we go through here. We're trying to keep some control, for the founders, and in most cases, it's not an issue because most VCs aren't going to invest unless they actually believe in the founding team. Now, they might not believe in every single member of the founding team, which is a separate issue, but they're very rarely coming in to clean house and just put in their people. It does happen every once in a while, and every time that it's happened to one of my clients, they've basically gone into it knowing that they weren't really aligned with the investor, that the investor saw some value in their assets and was going to go ahead and invest, notwithstanding the lack of alignment. And so at some level, it's like, you can sort of get what you deserve if you're accepting investments from people who otherwise don't agree with you on where the business should be going. So that concept of trying to have that long-term relationship will be important. All right, let's kick over and start talking about the term sheet, because there's some more things here to go through. Some of them we'll cover as we go through, and then a lot of the other ones in terms of right of first refusal and co-sale and everything else is frankly not negotiated that much. It's just not that interesting. Can you get us over to the term sheet? So to set the stage, here we've got Cool Commerce is the company, and Liz is the CEO and founder. It's been around for about 2.5 years, and this is again on the term sheet that you have. There's a little bit of the backstory. Ellie is at Hell's Kitchen Venture Partners. We already have a Tribeca Venture Partners at Union Square, and I live in Hell's Kitchen, so I figured that we'll have Hell's Kitchen Venture Partners. As somebody said, it's like badass venture partners.
Yeah.
It's a commerce company, so they sell they sell lots of interesting things. You could think of Aha Life or Etsy or Thrillist or Jack Threads or any sort of curated commerce type companies. They've raised about $900,000 of seed money so far, and they're going for a $4 million round here, of which Ellie's fund will put in about $3 million. And what we're going to do is Liz and I have discussed this, and the way that this often works is that the term sheet will come over from the investor. Usually after a significant amount of discussion, there's usually quite a bit of discussion before the term sheet comes over, both about the business. Some sense is probably given about what the valuation is going to be. Nobody wants to waste their time if they're totally outside the realm of feasibility, and I do think that goes for both sides. And so there's been a range of discussion right now. What we're going to do now is compress into a half hour, something that might extend over a period of days. And what we'll assume is that Ellie and Liz are having this conversation. Liz and I have been through the term sheet together, and I've given her my suggested markup, and we kind of have a sense of where we want to end up as a company. And Ellie, of course, has a sense of where she's comfortable ending up. Again, this is not Graycroft's term sheet. This is the model term sheet. So in a couple of cases, if she needs a nudge, I'll give her some more arguments for her side too. And I'll interject as we go along. But I'll let them kick it off. And Ellie, you want to kind of kick it off in terms of explaining the term sheet and how you came back?
Perfect. Awesome. Well, Liz, super excited.
Yeah, me too.
Yeah,
Thank you so
lots
much.
of good stuff here with Cool Commerce. So as you know, sent over the term sheet, and we talked about some of these, but what I wanted to do is kind of walk you through it. I like to, instead of just sending it, actually walk you through how we're thinking about it. I think a lot of this you're going to see is totally straightforward. I'm sure we'll come to some conclusion quickly. So
Fantastic.
Just to lay it out, obviously, Series A, we'll be investing, I think the round size, as we've talked about, $4 million. We'll do at least 3.
Perfect.
So there's room there for your existing investors or potentially a syndicate partner if there's somebody that you're interested in. We can discuss that. The pre-money valuation we have here, fully diluted, including the option pools. The option pools in the pre is $10 million. Obviously it's both, kind of standard for where you are as a business in terms of the Series A metrics, but also taking into account the sector that you're in and the exit multiples and how things are actually viewed.
Yeah, let's talk about that because I haven't found it to be too standard.
Okay, sure. Yeah, we'll table it for now because there's a number of other things that actually factor into that. So we can talk about it just run through the whole thing, and then we can go back to a lot of those issues. And then we've got the cap table in the back, which shows you what that pro forma structure looks like. You'll see, obviously, you still own a tremendous amount of the business, which of course you should. And then we go into, kind of founder vesting here and some other items around options. So, of course, here we've got the 1 year cliff, as well as monthly vesting, and also the repurchase right, such that if a founder leaves, the company has the ability to buy back those shares. I see that one of the people that you actually started the business with already left, so it
Bobby.
seems like you've got some experience with that. Dividends. So here it's a participating preferred security with an 8% accruing dividend. In this case, it's obviously for, so my thought process here is obviously it's kind of downside protection for us, given some of the discussions that you'd had last year with the potential acquirer, and you were thinking about kind of a lower offer. It makes me a little nervous that kind of the next person who comes around, you may be kind of excited to exit at a relatively lower number. So this gives me comfort that I'm protected in that scenario. But again, we can just run through all of this and then circle back to that. I'm sure you might have questions. And then, of course, there's other items in here, including IPO stuff, and I don't like to negotiate that at all. It's a waste of legal fees. Anti-dilution, this is pretty standard. It's broad-based weighted average. You haven't seen things like full ratchets except in 2000 and 2008 potentially. So that one's pretty standard. Voting, I won't go through each and every one of these, but these are, kind of the protective provisions. And, a lot of these are in here for edge case scenarios. So, in there to prevent things like, we wire over the $4 million and you dividend it out the next day to your cousin Joe, right? Like that's not good for anybody.
Definitely
that's a
not.
lack of fiduciary duty on our part.
That would never happen.
You'd be surprised. No, I'm just kidding. But we need to make sure that it can't happen and that, we need to be good stewards of capital as well. So that's what a lot of these are. I don't want to go through them one by one, but this is, we can talk about any issues you might have. And we move on to redemption rights. And so the thought process here is, this basically gives the investors the right to, it's really protection against what we call a lifestyle business. So meaning, you're growing, the business is doing okay, you probably get to profitability such that it's a sustaining entity. But that's really all. So you get a little bit further, you're doing okay, and you're pretty content. And you're not necessarily excited to sell the business. You're not necessarily excited to do anything that's going to spur growth and, actually build a lot of enterprise value. Yet, our time and our capital is kind of tied up in that, and that's really not the business that we're in. So this is to kind of prevent that, or it gives us all away.
I totally understand. I'm not in that business either. So
Right,
yeah.
exactly, to get out of that. Then board composition, proposing 5 seats here, given, so that is, one from the CEO, of course, and then your co-founder, and then 2 for the preferred investors, 1 for the Series A, 1 representing the angels and the seed investors, and then a final independent director that we both agree to. And then registration rights. This is in the broader bucket of things that I don't negotiate because they're irrelevant at this stage. And then right of first offer. So the major thing here is how we're defining major holder. So this comes along with it a number of other rights and will be referenced throughout the document. And that's something we can talk about because it really relates to your angel investors, some of whom don't meet this threshold. But of course, along with this are information rights and a number of other things that, pro rata rights that then fall to these, to whomever is within this definition. So, that's something I want to understand your point of view on. It can help make it easier if you have 70 angel investors and you can kind of clean up who you need to talk to about what. But that's not your scenario, so we can talk about that. The right of first refusal. This, I think, is pretty standard. The company first has the right to buy back any kind of secondary purchases, and then it goes to the investors. I would have written this differently. Anyway, drag along rights. Again, this the only discussion here is really around the percentage. We can talk about that broadly. Inspection rights. So this is these things are all pretty standard as well, and
And I think we can leave the rest of it. It's, the rest
I don't think there's anything
a lot
else.
of the rest of it, the
Yeah.
lawyers. So, I'll send back my markup, and I think that hopefully I can work directly with your lawyers to figure out those.
Yeah, I
things.
think those things are fine. So I obviously you're going to have a point of view on all this. I just wanted to walk you through all of it before we go into any specific terms.
I really appreciate that. And again, thank you so much. I mean, it's an honor that Greycroft really wants to, I'm sorry, not Greycroft.
Hell's
I wish
Kitchen.
Greycroft instead Hell's Kitchen really wants to work with us. I've spoken to Bobby at Bearco, and he just speaks so highly of you and says how much of a joy you are to work with. So doing my diligence, it's clear you guys are great. That being said, we have gotten several term sheets. It's a good time, as you know.
great.
And
Yep.
some of them have actually had significantly better valuations. But as you know, I'm in this to build a business, not to just win today. And ultimately building a business, I want to have a great partner on board. So I want to make this work. I'd love to leave this conversation making this work, but first we definitely need to flesh out a few of the terms here.
Sure.
Great. So some of the things that I'd love to talk with you about, just to kind of give a high level perspective. Valuation, I think, is fair. I think overall, though, so the 10 million number, I think, is fair, but not with all of these other terms, and I'll go into some of them. So specifically, the option pool, I'd definitely love to discuss, participating preferred, some of these protective provisions. I know you mentioned that you think that they're standard. I've definitely not seen those on other term sheets, and definitely stock vesting for myself and my co-founder. So let's just dive right in, if that's okay.
Just so you know, we didn't put multiple cap tables together, but in the original term sheet, Ellie asked for an 18% option pool as part of the fully diluted. The cap table you have is the one that Liz wanted to put together, which has a much smaller option pool. So we'll let you explain.
Should we even start with that?
Let's start with that. Yeah, of course. So I put in the 18%. So,
Yeah.
what were your thoughts around that specifically?
So what I will say is we have a kick-ass team. Our team is amazing, and I know who we need to hire. Ultimately, a lot of the people we're hiring are artists due to our business, and they're starving on the streets. So the salary we're giving them is plenty. So needing to set aside an 18% option pool just seems a lot aggressive from a standpoint of these guys are not going to require too much equity, and they are going to be really bought into the business because this is their passion, this is their lifestyle. They're able to connect that with their everyday career.
Sure.
So I'm thinking definitely a 10% option pool seems much more reasonable. We've even seen less than that, but I think a 10% will protect both you as well as our employees.
Yeah, so I think that's something we should certainly look into. So what I think makes sense is to see map out and kind of understand what are the key hires that we need to make over the next kind of 18 to 24 months.
Absolutely.
And then, some of those will be senior level hires that will come in expectation of equity. And then we should also have a buffer in there because inevitably things happen that aren't necessarily planned on. One of these hires that we, give a bunch of equity to doesn't work out. And,
absolutely.
So we need to have some flexibility, but let's take a look at, or maybe you've done that already.
We have.
Okay,
It's
great.
Right here.
Nice.
It actually, as you'll see, exactly what you're saying, we actually see that it's about 7.5% is what we think we need, but we do want to prepare for the worst and we do want to have some buffer room. So that's the 10% number is actually somewhat conservative, I think. So that's where we got that.
Okay, so let's, there's a lot of things that tie into valuation, this
Absolutely.
being one
Let's
of them.
keep
So
going.
let's go through the rest of those.
Great. In no particular order other than what I have on my lap. I'd also love to talk about the founder's shares, if that's okay.
Mm-hmm.
So is that okay with you?
Yeah.
Great. So something I noticed is that you're kind of forgetting the fact that I've been working on this company for 2.5 years, not just working, but like living this company, living, breathing, sleeping. And I think to kind of forget about that and set that aside and act as if I'm starting the company today just isn't really fair to me. And so I definitely think that we should, I've been working on it for 2.5 years. I understand if you don't want to give the full 2.5 years. I think a very reasonable in between is about 18 months, meaning, about a third vested. Obviously no cliff, et cetera, but I think that's much more fair for the work I've put in. As you know, you're investing in me just as much as this company, I hope. And so I hope that you can also give credit to that.
Got it. But you're fine with the then 4-year schedule otherwise?
So what I'm saying is I think that I should get credit for at least 18 months in.
Sure. So what you're asking for, if I understand it correctly, is 33% vested immediately.
Exactly, yes.
And then the remainder vesting over 4 years.
Oh, I see. Actually, I'd prefer if we could do closer to a 3-year schedule. I think that seems just a little bit more fair. Again, 2.5 years in, so that's still not as good as what I should be getting in theory with respect to how much.
Right. But this is one of those things actually that gets kind of renegotiated at every round, right? So, if we're aggressive now, it may be that you're having the same conversation, in 18 months when you're going to do the next round and, you end up back in the same place or maybe somewhere different. So I completely understand your point of view and do agree that you deserve some credit. But what I would suggest is that because there's a little give and take. I mean, 3 years, it's, the average exit, even from a Series A is 7 years, right? If we're being realistic.
Well, I expect you'll be giving her some more option grants along the way to help keep her incentive as we go.
Exactly, because, but we'll do so. And of course, there will be, a performance-based plan and there's other option grants along the way. So this isn't necessarily, the end all be all. However, I would be more comfortable with, 33% up front. That, I think that is a big concession, and I do understand the time that you've put in, but I would be more comfortable sticking with 4 years on the rest.
Something else that Liz and I have talked about, and I suggested
This
to
is
her.
my lawyer, by the way, Chris.
exactly.
Yeah, I don't have one of those, but,
exactly. That one. Normally, of course, I'd only talk if her lawyer was there too, but we also talked about the fact that this is, as Liz said, she doesn't really need the money right now, and so if she were to agree to 4 years, one of the things that she needs to be sure of is that if something happens and you end up with a disagreement, that she's still protected, and so I've told her that it would be pretty fair if she were terminated without cause for some reason, that she would have some acceleration of her vesting, and that might be able to be a compromise that would let you keep the 4 years in most circumstances, but give her some protection to make sure that she still walks away with a reasonable stake.
Right. No, that makes sense. We can talk about, what exactly makes sense in terms of acceleration. You don't want to be, we've got to be reasonable since we, in that scenario, which of course nobody is looking for, we're backing you here. We need to still have the flexibility to, go hire someone new, and because which we would inevitably need to do. So, vesting all of it isn't really on the table, but, I could be convinced of.
And I would never ask for all
right.
of it, but I do think 3 years is still very much a give and take given my 2.5 years in.
Yeah,
It's still
sure.
just
So
kinda a year
I would
and
be
a half.
comfortable with that 33% up front, 4 years, but then would probably give, for a year of acceleration upon being terminated for without cause.
Okay, let me discuss that with my attorney, but it's good to note. Another point I would love to hear just more your thoughts on why you went about wanting participating preferred versus convertible preferred. Why do you think that's fair, and how'd you go about thinking about that?
Sure. So, as I mentioned, it is, for the investor, it's kind of downside protection in a middling outcome. So there's a point at which it doesn't matter because you're going to convert into common. But there's a point at which, there's kind of a fair number of outcomes in the middle that are on the lower end, where it's really meaningful to the investor in terms of driving a return and an outcome that isn't what we're planning for, which is much bigger than that, which would make this irrelevant. But given the kind of early acquisition interest and this being your first time at it, and it really could be meaningful for you guys. For even a kind of smaller outcome in the near term, that's my concern. Is that a year from now there could be we're going in here at 10 pre, so we'd be at 14 post, and you get a $30 million offer, and that's you own 54% or 34% of the business. That's real. That's real money. That's really meaningful. For us, that's not very exciting.
I understand
this is
completely.
kind of trying to bridge that gap.
Yeah, and I do, since you've brought it up a couple times, I want to just put it out there. I know that I was offered an acquisition. I didn't take it, and there's a reason I didn't take it, because I'm in this business to grow this thing. I'm sure that we can IPO this thing eventually, and at the end of the day, that acquisition offer was nice. We smiled, we cheersed our beers, and that's about it. And so I need you to know that if you're going to work with me, that I'm not the type to take that. That's not my goal for this company. If it was, I would have taken it. And so at the end of the day, I want you to be in it with me. And I think that by taking a participating preferred route, it just doesn't feel like you're in it with me completely. It's one of those making the cake and eating it too kind of things. So.
Right, yeah.
Would you be willing to go to a convertible preferred?
So, I feel like it is a pretty significant, concession, but, given that we are staying at the 10 million pre, which is really where I wanted to stay. And quite frankly, the participating preferred can be viewed as a valuation item also. There's an economic value to it. I'm okay kind of trading that off in order to kind of stick with the 10 million pre. And then, obviously the option pool factors into that as well. I do think 10% is reasonable. I'd be happier at 12.5, just given.
It's just too much buffer, given we don't need to raise this money, so it's just too much buffer. But I really appreciate.
You don't think you need to raise the money, but, from what I see, you're burning a significant amount of cash. So, it may be that you do actually need to raise this money. But, I think you're being reasonable in how you're projecting these hires. So I don't think 10% is out of the question.
Let's go on protective provisions. Let's talk about those, because I know you trust me. I hope you trust me. If you don't trust me, take the term sheet back. But I cannot, the whole Cousin Joe, I think you said Cousin Joe, scenario, not only will it not happen with me, I know it won't happen with me. And so I think some of these protective provisions, especially the former half, seem fair and reasonable, and things that I'm seeing on other term sheets. But pretty much from 10 on, these are operational items that, to be honest, if you want this business to grow quickly, I'm really just trying to speak slowly so that you can find the paper. I can give it to you as well. Protective provisions. Ultimately, I know from 10 on that there's just no chance that that's going to be a problem, and it's only going to slow down our business if we need to do that.
Yeah, I mean, I have no interest in running your business. Obviously,
Right.
We're backing you to do that. But some of these are real. Actually, 10, just because you mentioned it, that's getting debt. That's I took hers.
No, it's fine.
That's
give and take.
Right. That's meaningful. and that's something that the board and the investors need to be aware of, and you need to consult and before doing that. Same goes with kind of increasing or decreasing the size of the board. That's something that the board should have a say on. I tend to agree. Licensing or selling all of the company's IP, that's pretty meaningful to the business and also to the enterprise value. So, what I think is a reasonable middle ground here is to have perhaps a different standard for the actual protective provisions and where we need agreement. So it could be more of what do I have here? Within the consent of the holders of at least a majority of the Series A. So we can do it such that it is more all of the preferred. So all of the preferred holders versus just the way that it's written today. It is a series vote rather than a class vote.
Would you be willing to think about for some of the operational things to move it to the board of directors? Because
yeah, absolutely. For some of the operational things, it doesn't need to be shareholder.
I just worry because I'm the one who has to actually go get everything signed, and every time you have to have a shareholder vote, that then you've got to go send it out to everybody and send notices out, and it's just
I just won't be able to grow this business like we need me to.
Yeah. And that is what we're in the business of. Yeah, no, I think it's reasonable for some of the operational ones that it can be more of at the board level rather than
All shareholders.
all shareholders.
Okay, maybe we can pick and choose there. I definitely think some of these, it's clear. I hope you trust me enough that we don't need any, any, but let's go through them later. We can pick and choose offline.
Let's go to the board composition a little bit to talk about that in terms of who gets to choose, and this is partly so that we can have time for people to ask questions.
Yeah, absolutely. So
My ideal board, I'm really excited about having a board. And I want to mention that, some of the term sheets we've gotten have no board offer and board seat. And I don't want that. I want a board because I know you help companies win and I want you on my board. What I'm really interested in doing, and just picture this. So myself, my co-founder, you, of course, I obviously have our seed investor on there, and then one independent board member. I'm thinking someone who is just like Bob Smith,
Right, Bob's great.
Yes, and he is like a dream independent board. And I've been talking to him, and I know he would love an advisory seat and potentially turn that into an independent board member, or Jack Sparrow, or any of them. And so
he's my favorite.
Yes, exactly. And so I know that we can just have a kick-ass board and grow this business quickly, efficiently. And so that's what I'm proposing.
I think that's great because that's also what I have proposed here.
Awesome. Fantastic.
I
know where you're going, but I got what I wanted, so no.
I want to make it very clear that so the interesting point here is going to be that she's caving too easily in some ways, because the big discussion here is often
I'm
over who
talking
gets
about who I want to decide the independent board member.
Okay, go ahead, go next. Keep going.
Keep going then.
But on that Jack Sparrow note, unless you want to interject. I do think it's important that it's someone who can really align themselves with the company. And I am going to be spending the next several months interviewing advisors for an advisory board and then potentially having one of them become an independent. And I think that requires as much work and diligence as I'm putting right now into even meeting and speaking with you. And I know you don't have the time for that. And so I do want to make sure that this independent board member is someone who my co-founder and I really appoint. And obviously we'll introduce them to you. You can tell us if there's any red flags there, and definitely let me know if you don't like them, and I'm going to be always respectful of your opinion. But ultimately, I think this is someone who we should just make sure that we're selecting.
So essentially, you're asking, did I hear you say to appoint the independent?
That's what she said.
Okay, so that is a little scary because again, you could theoretical cousin Joe here could end up on the board and be the swing vote with, you and the two founders.
I totally understand I have to say though, if you're going to work with me, I need you to trust me as much as I'm going to trust you. And I promise I will not be choosing someone who you are adamantly opposed to, because honestly, I trust you enough that if you're adamantly opposed to someone, it probably means they're not the right fit.
I totally understand that, and my hesitation here is because at the beginning, and of course we're both very excited about this, but everyone starts with the very best of intentions, and then of course nothing is ever going to go wrong, and I sincerely hope that is the case here. But we need to kind of set up the structure of the business, which is not only important right now, but is what is kind of going to be is going to be the basis of everything that of any subsequent rounds and all of that. I think it's important that we get it right. So I'm not comfortable with the common or the founders being able to kind of appoint to the independent seat, because then it doesn't really feel independent. It feels like another common seat. What I would be okay with is if we were still all able to vote on that. Perhaps you elect and put up for nomination or nominate to the rest of us your selection or your suggestion for who that independent could be. But it's important that we all vote on that.
Okay, that's interesting. Let me definitely talk with my attorney on that, unless you have any opinions right now.
And I think we should also, it's been interesting listening to all of this. Obviously, she's got her seed investors as well who are going to need to approve this. And her co-founder is not as sophisticated as Liz is, and so she's going to have to go. And he's been a little bit nervous about this whole process.
Yeah,
and so
absolutely.
I think we need to make sure that we go back and we get everybody's buy-in on these terms. But
of course, well, Liz is persuasive, so I'm sure that'll be no problem.
Is there anything else from your end that you're concerned about out of this?
No, I, since you guys did send over the markup, I was able to just take a quick peek, and I noticed that you also.
Things like the inspection, right?
Yeah,
That's just going to be so costly.
That I wanted to talk about, because I agree with you that, right now you don't necessarily need an audit, but I also think that it's important just from a governance perspective to have it in the documents, and then the board can waive the need for an actual audit this year, which I also think makes sense. You don't need an audit this year, but next year, given your very aggressive projections, it's obviously that's a real business with a lot of moving parts. It might make a lot more sense. So I think from a governance perspective, it makes sense to have it in here. But as a board, we can waive that for 2015.
Let me think about that one again. I just don't want to get. I don't want to.
No one wants to spend this
so
capital
much
on
money.
things
Yeah,
that aren't
exactly.
necessary. So we're aligned on that.
Okay, let me think about that. That's super fair.
And going back to my notes, I think the only other thing we didn't talk about was the accruing dividend, which is, I think, something that it was standard a while ago.
Well,
but it's pretty old-fashioned, I have to say. Yeah,
Well, I gave on the participating, and so you don't
yes.
really. Well, and part and parcel of that was also the accruing dividend. I wouldn't expect. It would be extremely unusual to have a straight preferred with an accruing dividend.
It would.
So I'm
So you're
with
on
you.
that too?
Yeah.
Good.
Yeah.
Well, we can go back and talk about that.
Yeah.
So, well, thank you very much. And I think that we'll go back and circle up
Thank
on
you
our
again.
side. And why don't I plan to send you a revised markup that will kind of reflect where we come out on all these things.
Right. So that sounds great.
Awesome. Thank you so much. I really hope to work with you.
Guys.
This is great.
Okay, so obviously there were a whole bunch of things there where we kind of had to shortcut past, but I think we actually hit most of the major things that you would talk about. Questions? Yeah.
So, Liz raised $700,000, is it? Convertible note?
Yeah.
But let's suppose there was a cap that was significantly lower than the 10 million free. How is that factored in?
It'll end up, so the way it's set up right now, there'll be a full term sheet that's sent to you. I don't remember what the cap was. There is a cap in there, and so essentially what you'll see on the short form term sheet here, you'll see that the price per share is $1 a share because it's a $10 million pre, and that the angel investor put in $300,000 and gets $388,000 worth of stock. So what will end up happening is that there'll be a function of the cap. Or the 20% discount that will cause additional shares to be issued. And this is, again, if you didn't negotiate the seed documents right, one of the things that people have highlighted recently to put in the back of your head is that a convertible note, you should provide that it converts into preferred up to the principal and interest amount, and that then any additional shares you get because of the discount converts into common. You get common shares for that, and that's actually something. This is actually something that's only been in the last couple of years that people have really started focusing on.
That's right, because ultimately then you end up with more preference than you deserve.
Right. So
Essentially.
in other words, this person, if you didn't do that, this person would have put $300,000 in and gets $388,000 of preference if the company got sold the next day.
So they essentially had more than a 1x liquidation preference.
And that's actually sometimes, depending on how many seed investors you have, that's sometimes something that Series A investors, I've had Series A investors come in and argue to say, look, you need to make sure that the seed investors don't get this extra preference because, we agreed to go, one of the things we didn't talk about here, because it's all A with convertible, sometimes you have seed stock, and then the A is the A pari passu, or is it senior?
Yeah,
To
it will
the,
always have that
to the
discussion.
seed?
Yeah, whether it's senior. So if it's priced, then this is another thing that you have to put in a Series A, which you didn't used to have to do because it didn't wasn't as big.
Right.
But now it's already it's a point that you always have. So if it's a priced round, it will be in the term sheet, whether it is senior. So the Series A gets paid out first, then the seed, then the common, or whether it's pari passu. So we all get both the seed and the A are on the same terms, and that's particularly a lot of these things are. Like having participating preferred in at the A, the reason that that's tough is that, later round investors never give back terms. They'll never say, oh, you had a 3x liquidation preference? I don't want that. I'll take a 1x. Like that never happens. It only gets worse. It doesn't get better. So if you set it up with participating preferred senior to the seed, then you go raise a $20 million round, you better expect to be junior to that $20 million of participating preferred, which ultimately hurts you as the Series A investor. Unless, you decide, the only scenarios where that doesn't hold are, if you decide that you're the only one who's going to fund the business forever, or that they don't need any more capital, and this is the last round. And if it's the last round, which is why you'll see this more often in later stage rounds, then it's fine.
And this is an important thing in terms of this discussion, that Liz really wanted to make sure, $10 million was kind of like the minimum that she was willing to take for this. And in a negotiation, she probably in her heart wanted the 12, right? But was willing to back off on that to take away understanding the long game here. And one of the things we talked about when we talked about this, Ellie as an early stage investor is actually very much aligned, because she'll go forward. And she said, really, I'm asking for all that? Because it really is quite punitive. If the accruing dividend and the participating preferred is very, very punitive to the common. There are liquidation spreadsheets where you can sort of run through the numbers, and it's very stark. You get 5 or 6 years out with accruing dividend and participating preferred and a sort of a marginal outcome, and there's really nothing left for the common.
No.
And it really puts everybody in a tough spot. So she's kind of looking out. One of the things to look for when you're talking to Series A investors is to kind of get a sense. And the comment you made about the later round investors moving down to the A really resonated with me.
Yeah. So something that we're seeing increasingly right now, because the kind of pre-IPO rounds and the big growth rounds right now are so just crazy. There's a lot of heat in
Up until today, anyway.
Yeah, true. Last week, in that particular. So what you're seeing is a lot of those investors who used to play there moving earlier and earlier. But what they bring with them are all the things that are totally okay in later stage rounds, and then they bring those earlier. And that includes some of these terms. That includes just some kind of norms that exist in early stage that are different in later stage, including kind of the sanctity of the term sheet, right? You do your diligence before it. Anything that you do after is usually, it's legal, it's confirmatory. You're usually not learning anything new if you've done the work as you should have kind of in advance. A lot of later stage investors actually do a term sheet first or an LOI, or maybe they'll call it something else, a term sheet first, do the diligence after, and will more often walk because it's just
Or
kind of-
renegotiate.
or retrade. Right.
Right.
Exactly. Or retrade. And, we found something in diligence, blah, blah, blah. But it's just kind of how the world works at that stage. And, as they move earlier, people freak out because it's just not kind of how the early stage ecosystem works.
One thing we didn't talk about here was the exclusivity period in that in terms of
yeah.
the renegotiation that it originally
asked for
started at
60 days?
60 days, yeah.
Nice.
Right, yeah. and that's it's sort of 30 to 45.
30 to 45.
The idea is enough time to kind of get stuff done. Get that lawyers are slow sometimes, and you have to get the. Where's the documents? I haven't turned them yet. I'll get them to you eventually. Yeah. But also time to do diligence. But the company's burning cash. 2 months can be a meaningful amount of cash that they're burning because you don't want to go. A lot of times people are really pushing it to the edge because you want to hit that milestone, that valuation hurdle to get the higher valuation, and so you need to leave enough cushion. We always tell them it's going to take 4 to 6 months, but if you're 4.5 months in and then you got a 60-day no shop, then it really makes it a problem. So again, know who you're dealing with. A good investor who's kind of historically an early stage investor can get through things quickly because, like Ellie said, they're not going to give you the term sheet until they've actually done most of their diligence. And then it's just process.
You talk about pro rata for the A round and for the earlier investors as well. I heard the founder goes back for the earlier investors sometimes to make sure they get that pro rata, and then I don't know where it gets the B or C round when the A, I imagine it's there, but what happens is, the C round comes in and says it's freaking 40, there's no room. What do you do then?
It's always a negotiation. So I'll tell you first of all that it's always a negotiation. That if I'm and in this case, we just did a very sort of rough and ready thing. Sometimes now angel investors who are doing convertible notes want a pro rata right, a preemptive right, so in the note as well. And really good, angel investors are going to double down as you go along. You'll talk to VCs and their top 2 or 3 deals, which they follow along every single one, where they make the most of the returns. And so that ability, that right, is something that people really hold on to. You get to B or C, and it becomes a negotiation because then what Liz will say is, look, we don't want to take a ton of dilution, but we really want to get this investor in, and they really need to put 25 million in. And so will you agree to cut back now? And people, usually are pretty reasonable if they're kind of aligned on what they're more likely to do it if it's a huge step up in valuation. You say, okay, fine. If you can find some schmuck who'll invest at a $100 million valuation, fine. But they always want it, and so I think as an A investor, it's hard to argue against it. If you have a seed round.
Actually not giving it to them later on, how you get around that?
It is what it is. I mean, so there's at a certain point, you want the company to get the round done, whether you're their first angel or their A investor or the B investor. And if in order to get that round done, that investor needs all 30, it's not a happy day, but you get the round done.
You can always call a seed investor and say, listen, if you don't cut back a little bit, this won't happen. Which one would you rather? And usually they're pretty understanding.
Yeah, and then at a certain point, different funds, different investors, people have different strategies. It's a rarity that absolutely everybody on the cap table can continue to invest all the way through to an IPO. I mean, it's just your original angels. It doesn't that's not. Most of them, there's no way they can do that. Same with some of the, earlier stage funds that are, a certain fund size means that, they invest at a certain stage and their business is not investing in $1 billion rounds. So, it kind of runs the gamut. But
and the other thing too is remember the pro rata here isn't that, the pro rata is basically they get to keep the same percentage ownership. So if you own 20%, then you could buy up to 20% of the new round. So there's still room. The other thing that happens sometimes, if you have to, you increase the round size to bring somebody in. But I think, from a negotiating standpoint, it's absolutely one where going for the A that Liz is gonna have to stick up for her current investors and say, look, they backed me before. It's important to me. I want to be fair to them. This is something that they actually expect, and go from there. And most A investors aren't going to cause a problem.
but that's-
Because frankly, she wants to raise the money. She can use the money. Yeah, it's not a problem with the A round. You're right. It's more of a problem with the B or C
Yeah,
round.
and that's also and part of the major investor threshold is who even gets that,
Right.
which is why it's important to define.
Could the earlier stage investors raise different kinds of SPVs or something to fill out the program, or it has to be their own? Is there
No, people do that.
Yeah, you can assign your rights.
So Liz had mentioned hiring artists and giving them a smaller amount of equity percentage just because they're starving and they don't require that much money-wise.
Sorry to all the painters here.
How is the value of those options determined? Is it just set on a standard percentage, or is there a way to determine the actual value that is then allocated to those artists?
Age old question.
Yeah, this is a good
The question of how much, and Ellie, I'd like to ask you to kind of do a first response on this in terms of how much, how you sort of figure out the equity budget. Because Liz came in with her whole equity budget, and that sort of presumes that you've made an assumption about how much you have to give to people.
Right. So there's there's a lot of variables, and it's kind of an art rather than a science. It's some of them are more standard. So whether you're at a certain stage and you need a certain senior hire, so call it a point. And I'm just kind of giving you high level stuff, right? There's always exceptions, and then. So anyway, so it depends on the stage, it depends on the type of hire, and it depends a lot of the time on what that employee values. So there's a trade-off. You don't get both a tremendous amount of cash and a tremendous amount of equity. You need to understand if that employee is motivated by equity, and you hope that they are.
Is that something you're seeing in New York? Because I've heard people talk about that the cost of living here is such that cash is actually more important.
It's
to
also
many
in
people.
certain industries. So when people are coming out of kind of a traditional industry and then will move into startups, they don't always value kind of startup equity like someone who's maybe in the startup ecosystem. And I've found it to be more pronounced out of certain industries.
In tech,
Retail, for example,
retail or financial, they're
like
all
don't
right.
care, not across the board, but don't care as much, like care more about cash comp because that's how they're compensated and that's how they think about it. And so as a result, even though it might be, maybe it would be 1.5 points at the stage of the company for that particular hire, if you're giving them more cash, there's a trade-off there, and that means less equity. So, it is kind of a balance.
There are some kind of generalizations that everyone agrees with, like you hire a lot of salespeople, it's going to be a lot of cash. You hire a lot of engineers, it's probably going to be a lot more equity. So I think it also depends on that.
And there's some pretty
then-
good blog posts out
Yeah,
there as
there
well.
are.
I mean, Fred Wilson has done one. You may have done one, I don't know, but there's a bunch of people who have, so if you look
And there's
at
a good Wealthfront one.
Wealthfront does a nice
and
one.
it's about, what I always say is just start to have a framework for how you're doing it instead of it's okay at the very beginning, but once you start, you raise a Series A and, so kind of have a framework around, this is how we look at it. Maybe there are levels within the company, tiers within the company, or within certain organizations within the company, such that you're being a little bit more methodical about how you're
right,
doing
like a
it.
director level, and a manager
Exactly.
level, things like that. At the seed stage, it's much more ad hoc.
Yes.
We have access, and so sometimes clients will ask us about this, and we'll. Some VCs have put together charts of sort of what the average equity is at different levels, and then there's also online databases that we can access, and you can sort of get a sense. The problem is, if there's a range, it's a range of 0.5 to 2.5.
Yeah, which is not helpful.
It's sort of meaningless at some level,
Yeah.
and and partly it's the art part of it too. Is how experienced are they? How important is that particular person right then to you? How hard would they be to replace? How long you've been
Are
looking
they
for
based
them?
in New York or New Jersey? It's like everything.
Yeah, well, I mean, it could be that you're willing to do something totally off market because this person would be so incredibly valuable, and in which case, I don't care what table you look at. You're going to do what you need to do to get them.
And this is one place where the board could be really helpful actually in terms of thinking about that part, because if you're doing something that's off market, the one thing that the board can really help with is serve as an external sounding board. And Ellie says, "Really, Liz, are you sure that they really do walk on water?" Right, and that's an important part. This is the part with the board, and frankly that I as outside counsel do as well, is that we're not in there every day. Liz is there every day dealing with things, and so if you get somebody who You want somebody who's productive on the board, but who's also willing to push you sometimes. And so, having a good board member isn't necessarily totally non-confrontational. They're helpful, but there's an element where, like Liz said, getting ready, doing the deck and everything else can be tough. But if you do a good job afterwards, you've come away with insights into things, and that goes with equity and everything else as well.
And as much as the board member can push back on you, they can also really I love it. We're still a really early company, and so when we go after these, oh my gosh, this is my dream person, board members are also really good at closing. I don't know if you do that a lot. I would guess you do, but closing hires. So being that final round where they take them out for drinks and they really schmooze them, and you should get your board member to help you with that when you need it.
So we'll take one more question, then people can have a chance to hang around and chat. It's 8:15. I'll go far in the back there.
Yes, as an entrepreneur, I hate when others can't concur. If you're reading the A, you're stuck with your provider. What percentage of deals receiving are 100%?
0.
He asked if you're a He asked how often she sees participating preferred.
In a Series A. Same. I mean, I tend to view the two of them together, which isn't completely true, but most of the time it is. I mean, it's because unless in those two scenarios that I mentioned, you're going to fund the company forever, or it's the last capital they need, particularly if you're kind of a smaller fund that can't necessarily support the company forever, then it's not necessarily in your best interest to do that in the A because you're going to be sitting underneath.
So I'll say that part of it is that Ellie's lucky that she can pick and choose companies a bit, because I think in my clients probably 15 to 20% still have participating preferred.
We see it in later stage.
Yeah, but even in the A, we're seeing it sometimes, and it tends to come from.
Is it in New York and in California, or are these companies based elsewhere?
The companies are based here, but they're companies who maybe had trouble raising from traditional VCs, and so they're going out to the Midwest or they're going to the Southeast so it's non-traditional.
So that I would say.
Right, it's non-traditional VCs. But
that's
based
totally
here.
fair. I'm being a little bit too.
So it's like one of those things.
Blasé about it, but
it's a trade-off, but it's one of those things that absolutely you're right that once you've agreed to it, it never goes away,
you keep it. Or so I actually.
It's more important than evaluation.
Well, it's a valuation term. Yeah, I mean, yeah.
Well, it is.
Part of it.
I think it is probably more important. It can be more important over the long term if it's a relatively small increment of valuation, which is what we chose to give away a couple $1 million of valuation, which Ellie probably would have given us if we had agreed to all those other terms.
Yeah,
right?
no, it is, and it's. To be fair, there an investment I did earlier this year, actually, the term sheet that they got initially from the lead had participating preferred in it, which. We were just participating and weren't leading it, which was the first thing we said, absolutely not, and got rid of it. But, but again, it's usually not investors at the A who are, kind of your traditional funds in places that are doing a lot of VC deals. But we see it outside of the major markets.
Absolutely. All right. Well, thank you all for your attentiveness and for sticking with us on this summer evening.